Potentially devastating. Although it's being touted as historic and bipartisan, Biden's new infrastructure bill could be dangerous for you and your money, no matter where your investments are. Today, we're going to be breaking it down and explaining what this move could mean for the future of crypto regulation and the American economy as a whole. This $550 billion infrastructure deal is intended to stimulate the American economy. Where it starts to get more complicated is this. The bill states that part of the costs would be partially paid for by cryptocurrency enforcement. And it's no small amount. Not 1 million, not 1 billion, but $28 billion of the expenses will come from forcing crypto traders to contribute, a number that was just decided upon pretty much arbitrarily. The aim of the bill is pretty standard and inoffensive. Legislators seek to strengthen economic growth and create jobs, with a heavy emphasis on the nation's sustainability and competitiveness. In fact, the bill is projected to create 20 million jobs over the next decade. That's significant, and it's obviously a good thing. Job creation is important, infrastructure is important. My thoughts and sentiment here shouldn't devalue that. At the same time, that record $28 billion gathered from crypto taxation enforcement is likely only the beginning of a new set of policies that will have drastic, potentially catastrophic effects on the market. The revised proposal for the bill includes tightening the transaction reporting requirements for crypto traders and obliging companies to disclose to the Internal Revenue Service any transactions of digital property for a value of $10,000 or more. These are the kinds of decisions you'd expect coming from nations where destructive crypto regulation is common, like mainland China, for example. But when these legislative decisions start coming to practice from US lawmakers, the effects are going to be massive. It's fueled by a rising anti-crypto sentiment shared by many who seek retribution for the economic and environmental impact of crypto. While additional taxes on crypto would certainly hurt some investors, it is possible that clear regulation would allow more people to join the crypto markets. The Biden administration was earlier reported to work on a comprehensive regulatory framework for the crypto industry. But since these rumors, there have been no developments. This, along with the comments made by Gary Gensler, SEC President, and Janet Yellen, Treasury Secretary, suggests that the authorities are continuing to hammer out regulations. The real problem with the infrastructure bill is that the law defines a crypto broker, quote-unquote, as any company or individual that deals with cryptocurrency. This term may include virtually every participant in the US crypto sector, says lawyer Jake Chervinsky of Compound. Here, broker is an ambiguous term that can apply to anyone who is a broker of some kind. Let's go over some of his tweet thread to get a better understanding of what he means here. Quote, "Here's the deal with the US infrastructure bill. A new provision has been added that expands the tax code's definition of broker to capture nearly everyone in crypto, including non-custodial actors like miners, forcing them all to KYC users. The bill expands the definition of a broker to include any person for consideration is responsible for and regularly provides any service effectuating transfers of digital assets. This definition is so broad, it could apply to nearly every economic actor in the US crypto industry if read literally. That includes proof of work miners and proof of service validators, since providing a service to effectuate transfers of digital assets for consideration seems to fit both. It might include a huge range of DeFi market participants too, like DEX LPs, liquidators, protocol governors, etc. Depending on what for consideration means, it might also extend to non-economic actors, like node operators or wallet developers. That scope here could be massive. The tax code requires brokers to comply with IRS reporting requirements. Most importantly, They have to give Form 1099s to their customers and file them with the IRS too. To fill out Form 1099s, brokers have to collect customer data, including name, address, phone number, etc. This means brokers have to KYC customers to comply with IRS reporting requirements. As a result, the provision functions as a surveillance mandate, just like the one Secretary Mnuchin proposed in the final days of the Trump administration. As before, this is a very bad idea. As those who understand crypto already know, users are pseudonymous and access is permissionless. It's literally impossible for non-custodial actors like miners to get the information they need to form 1099s. In practice, this could mean a de facto ban on crypto mining in the US. The organizations working to protect blockchain industry players and investors, such as the Blockchain Association, Coin Center, and the Association for Digital Asset Markets, commented on the proposed regulatory requirements Thursday, objecting to rules that would enable authorities to single out individuals. The Chamber of Digital Commerce said that their organization suggested changing the bill wording to narrow the definition of brokering activity, which is designed to exclude miners and financial platform providers that use decentralized digital currencies. Do I believe these politicians are actively trying to kill crypto? No. But I do think that the consequences of this bill could lead to a snowball effect that will have potentially catastrophic effects for cryptocurrency, not just in America, but the entire world. Tax compliance is seen as a significant obstacle in the cryptocurrency market, and like I said, legislators want to generate $28 billion in new tax revenue to pay for these initiatives. This is a challenging problem since it involves laws about banking and securities. It spans both federal and state legislative authorities, from the tax committees to the banking committees. Industry leaders have vowed to oppose the proposed changes, but they're going to have a hard time doing it. If the Senate approves the infrastructure package, members of Congress will be reluctant to shoot it down. Now, this might sound contradictory at first, but broadly speaking, this isn't a bad piece of legislation. In all fairness, if you research it, you'll find that there are genuinely a lot of ways in which it would positively affect American life. Things like funding Amtrak, high-speed internet, electric cars, highway and road improvements. What the bill seeks to do with its funding is great and positive and will affect us in a positive way. And when combined with the $3.5 trillion reconciliation bill, in most aspects, it's a decent move. But make no mistake, regulation like this is only the beginning of what could be the sterilization of the cryptocurrency market of not only the United States, but the entire world. And trust me, people will feel these economic effects whether or not they themselves have crypto investments. But what do you think? How do you feel about these proposed cryptocurrency regulations? Please let me know in the comments below. And if you'd like to support independent tech journalism, please consider subscribing to the channel. I really appreciate all the support so far, and it's motivated me to keep going. Thanks for all the support and helping the channel grow. See you soon.